Thanks for joining Kevin and I for the market update for the month of July. David's on a well-deserved vacation back east visiting family. David, hi. Equity markets were actually really good in the month of July. The S&P 500 was up 3.11%. The TSX was up 2.14%. And the MSCI World Index was up 3.1%. So we're all happy about that. So what was moving the market in July? Both the US and Canada raised interest rates 1/4 point. And both governments mentioned that they're going to be looking at things from a meeting-to-meeting basis to decide whether any further increases are needed at that point in time. They also mentioned that any decreases in the market are probably unlikely until mid-2024. So if you think that interest rates are going to drop quickly, you're probably wrong, but we'll wait and see. Despite these increases, inflation was softening, so that was one of the things that was moving the market positive. So inflationary numbers have been coming down. The jobs report in the US was at a 2-year low, which means that it's 2 years ago that they're looking at numbers that were as slow adding new jobs as they are right now. And 51% of the companies have actually reported in Q2 earnings, and 80% of those were above what they expected. So again, that was good for markets. Kevin, looking ahead, can a bit of worry be a good thing?
As odd as it sounds, it can be. In these economic environments, enthusiasm and expectations are kept in check, which helps prevent valuations from coming untethered from fundamentals. And upward market momentum is then able to be maintained as worst-case scenarios don't come to fruition and the economy continues to move forward. Now, financial market history is filled with the next big crises talk, and while these events may cause disruption and market volatility, they are almost always temporary, and markets ultimately resume their upward climb. Now, of course, it is unlikely that the path forward will be free and clear as new developments seemingly come out of nowhere and add more items to a list for investors to want to sell investments. And this is why we feel it's a really good opportunity to re-explain that it's time in the market, not timing the market, that is the key to building wealth over the long run. Now, markets may lose their footing temporarily, but they almost always refine their traction and continue to climb upward, leaving those who opted to jump off with a long road ahead to climb back up. As always, if you do have any questions about your investments or the markets in general, feel free to reach out to Harry, David, or myself at any time.
Great advice, Kevin. Take care.